Hello and welcome to the Warr Hunt Quarterly Investment Update for the period ending 31 December 2020, and a happy new year to all. Well, it's certainly been a very interesting last 12 months, so I think we can all attest to that. And finally, Steve, you actually got a little bit of lockdown, have witnessed some of what we've been going through for the past sort of three and a half to 4 months to the end of the year. So with that in mind, Steve, perhaps you could give us a bit of an update as to what's happened, say, for the end of the quarter and to the end of the calendar year, being sort of 31 December.
Yeah, thank you, Sam, and welcome everyone. Yes, we have had a little bit of a lockdown here in the northern beaches in Sydney, but it all seems to be clear now. Well, let's have a look at this slide here, which is an overview of what financial markets did in 2020. And despite the Australian share market dropping to its lowest point in 8 years in mid-March, we've seen a really strong rally through April and December. And it's really put the market pretty much back on par with where it started. In fact, this has been the best December quarter for the ASX 200 in its history. And that's really helped largely by a record-breaking run in November. Now, the market is still about 7% shy of where it was in February before the pandemic hit. But nonetheless, it's been a remarkable change in fortune, not only in Australia, but around the world. Over in the US, despite the pandemic, the S&P 500 is up by 16% for the year. And that's a lot better than its historical average, which sits around 9 or 10%. Let's just quickly look at some of those asset classes and bring out a few things. First of all, it's worth noting that both Australian bonds and global bonds have returned, collectively 5 and 4% for the year. And that's despite the fact that yields are pretty much down at around 1%. So global bonds are still delivering over the year. You look at international markets, they've returned about 5.7% for the year. And the emerging markets have had a good year. They've beaten the developed markets. They've returned 7.8% for the year. Now, global REITs, as you can see in that chart, have been the worst performing asset class over the year. But Australian REITs had a very strong quarter. They returned about 13.2% for the quarter.
Obviously, in recent days, there's been a lot of noise in the US with, say, the storming of the Capitol building and Trump being banned from every platform on social media. But the story behind the stock market's been really interesting too. It's sort of a tale of two cities, if you like, Steve. What's been happening in the US?
Look, international markets are absolutely a tale of two cities. The Europe market is negative for the year, really led by the UK, which is down about 14% for the year. But the US market, as I mentioned, the S&P 500 is up around 16%. And if you look even deeper into that, what's driving that strong US market, and we've seen this slide before, Sam, it's updated now to the end of December. It's this group of stocks which have got that nice acronym, the FANGs. It stands for those really large technology stocks, Facebook, Apple, Amazon, Google, and there's a few others in there as well. And you can see on the chart there that the FANGs, which really account for around 25% of the S&P 500, they're up about 100% for the whole year. Which is really extraordinary. Names like Tesla are also in that group, and Tesla is up like 740% for the year.
Yet to make a profit.
Yeah, they're yet to make a profit, that's right. In fact, they've only just come into that S&P 500 index late in the year as well, but it's having a remarkable run. But it's worth noting something you just mentioned about Twitter banning Trump. In fact, Twitter are down about 6 or 7% today because not just over Donald Trump, but I think the market is saying perhaps the social media platforms need a lot stronger regulation than we've currently put around them. And so just because the FANGs have had a terrific run does not mean that that run will continue into the future.
So, Steve, you've mentioned two factors that are driving returns around growth and value, and it's probably an opportune time just to recap on our investment philosophy at Warr Hunt, which would obviously be familiar to all of our clients and audience. But really, what we're trying to deliver is the greatest certainty around investment returns for our clients so that they can achieve their goals and objectives. And the way that we do that is really by leveraging the latest academic research available to us, which has identified primarily three factors in driving equity returns. One is the market return, that you should expect a high return from a stock market over time when compared to cash or bonds. And that may or may not be true in short periods, like 12 months or under, but certainly over the longer term, that is correct. The other piece that we focus on is really around the value factor, and that's looking at unloved stocks as compared to stocks that you've just mentioned around the FANGs, that we know that value type stocks or those unloved stocks will perform over time or outperform growth type stocks. And the other piece that we focus on is smaller capital stocks, or smaller stocks should outperform large stocks over time. And really what we're about is just weighting or tilting our portfolios towards those three factors in order to drive performance over the long term. So Steve, with those sort of three factors in mind, how's that panned out for the last sort of quarter and 12 months, both here in Australia and globally?
Yeah, Sam, let's start with the factors in Australia. And the chart I put up now, I mentioned earlier that Australia's had its best December quarter ever. And if you look at the far left arrow pointing up, that is the overall market, the ASX 300, and it's up by 13.8% in a quarter, which is fantastic. Small caps up by a similar amount, but have a look at the value stocks, up by 18.8%. So a very strong value premium in the quarter. Now, when we go to look at the second row, looking then at the 12-month period, as we mentioned before, Australian market fairly flat for the year, but small caps, a really strong small cap premium in the market there. It's they're up by 9.2%. So you've got really a 7.5% premium, a small cap premium there. Now, not surprisingly, with what we've talking about with the rise of tech stocks, and of course in Australia as well, which is the market is quite concentrated in financials and energy stocks. Both of those have done poorly over the year. Technology stocks, of course, have done quite well. So you'll see there's a negative value premium over the year. But to reiterate, strong value premium over the quarter and very strong small cap premium over the year. Now, when I move to looking at the global factors, we see something similar here.
So Steve, with those factors in mind, has it actually panned out for the Warr Hunt portfolios? I know we've got sort of a sample of some of the portfolios here to discuss, if you would like to just talk us through those slides.
Yeah, thanks, Sam. So we've got 4 samples here. I'll really only talk to 2. The enhanced asset class portfolio that's 55-45 means 45% of that portfolio is in bonds and the 55% is in equities. And what you see here, we've already mentioned how those equity factors have been positive over the quarter. And I mentioned also earlier that, in fact, bonds have done quite a good job against cash. And so what you're seeing for this first portfolio, the 55-45 portfolio, is really superior returns, outperformance against the benchmarks over all periods. Let's jump now to the high growth portfolio, and that's what we'll call the enhanced asset class 100-0 portfolio on the right-hand side there. So that's the portfolio that is 100% equities. It's basically made up of 50% Australian equities and 50% international equities, which includes the emerging markets in it. And no surprise, when you look at the 3-month and 6-month performance, it's good outperformance by about, in the quarter, it's about a 3% outperformance over the market. And that's due to the value and the small tilts really kicking in and delivering that outperformance. Now, no surprise, as we go out a little bit longer, we look at a year and then 3 years, once again, because of that extraordinary performance of those large growth technology stocks, particularly in the US, you will see underperformance there over a year. But note how you move out to 5 years and a bit longer, things even out. And when we look at that portfolio since inception, again, we see outperformance over the benchmark.
Thanks, Steve. And thank you to all for joining today's presentation. I hope you've found it useful. We'll certainly be in touch with you all around your portfolio returns, and we'll be sending out the report shortly. But stay safe, and we look forward to catching up with you soon. Cheers.
Terrific. Thank you. Bye-bye.